Ladies and gentlemen, good day and welcome to Shalby Limited Q3 FY26 earnings conference call hosted by Elara Securities Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kashish Thakur. Thank you and over to you, sir.
Thank you, Avrat. Good afternoon, everyone. We welcome all the participants to Shalby Limited Q3 and 9 months FY26 earnings conference call hosted by Elara Securities. Today we have with us senior management representative from Shalby. We will start with the performance highlight from Group CFO of Shalby Limited, Mr. Amit Kumar, and Mr. Deepak Anand, Chief Executive Officer of Shalby Medtech. After that, we will open the floor for question and answers for all the participants. I will now hand over the call to Mr. Jigar Todi for important disclaimers regarding any forward-looking statements that may be made in today's call. Over to you, Jigar.
Thanks, Kashish. Good afternoon, everyone. Our investors presentation is uploaded on the stock exchange website and our company website, shalby.org. We do hope you have already had the opportunity to go through the presentation. Please note that some of the statements made in today's call may be forward-looking in nature and may involve risk and uncertainties. Kindly refer to slide number 2 of the investor presentation for a detailed disclaimer. Now, I would like to hand over the call to Group CFO, Mr. Amit Kumar, for his opening remarks. Thank you, and over to you, Amit.
Yeah, thanks, Jigar. Good evening, everyone. I'm pleased to welcome you all in Shalby Limited Quarter 3 earnings call. I'll walk you through the consolidated financials and standalone financial performance of the Shalby Group in the Quarter 3 FY26. In order to start with, I'll first walk you through the consolidated performance for the Q3 with a comparison on year-on-year basis. For the consolidated revenue in the Quarter 3, it has been 279.4 CR versus 281.1 CR in the Quarter 3 last year. This is marginally down by 0.6% on year-on-year basis. Our consolidated EBITDA has been 37.5 CR in Quarter 3 versus 39.3 CR in the Quarter 3 last year, with a margin of 13.4% in Quarter 3 versus 14% in the Quarter 3 last year. This is marginally down by 0.6% year-on-year basis. Consolidated PBT of 9.2 crore in Quarter 3 FY26 versus 12.4 CR in Quarter 3 FY25, with a margin of 3.3% in Quarter 3 FY26 and 4.4% in Quarter 3 FY25. This is down by 1.1% year-on-year basis. Our consolidated PAT has been 1.3 CR at a margin of 0.5% in Quarter 3 FY26 versus negative PAT of 3 crore with a negative margin of 1.1% in Quarter 3 FY25. This shows an improvement of 1.6% on year-on-year basis in the PAT margins. The group continues to maintain a very strong balance sheet with a low gearing ratio of 0.41x with a net debt of 408 crores. Now I will be running you through the standalone performance of the hospital business with a year-on-year comparison. Our standalone revenue has been 221 crore in Quarter 3 FY26 versus 226.9 crore in Quarter 3 FY25, which is down by 2.6% on year-on-year basis. Our standalone EBITDA has been 35.4 crore in Quarter 3 26 versus 48.4 crore in Quarter 3 FY25 with a margin of 16% in Quarter 3 FY26 against 21.5% in Quarter 3 FY25, which is down by 5.5% year-on-year basis. Our standalone profit before tax has been 21.9 CR in Quarter 3 FY26 versus 35.8 CR in Quarter 3 FY25, with a margin of 9.9% in Quarter 3 versus 15.8% in Quarter 3 last year, which is down by 5.9% year-on-year basis. Our standalone profit after tax has been 13.8 CR in Quarter 3 FY26 versus 20.7 crore in quarter 3 FY25 with a margin of 6.2% in quarter 3 FY26 and 9.2% in quarter 3 of FY25, which is down by 3% year-on-year basis. At a standalone level, we have a net debt of about 54.5 crore approx. Our standalone ROC stands at 11.1% in quarter 3 of FY26. Our ARPOB has been 43,171, which is up by 1.1% as compared to similar quarter last year, which had a ARPOB of 42,704. And similarly, our loss has been 3.62 in the quarter 3 of the FY25 as against 3.9 a loss of in the quarter 3 of FY26. On to the occupancy. Our occupancy rate has been 44% in quarter 3 FY26 versus 46% in the similar quarter last year. If we talk excluding the Shalby International, which is PK Healthcare in Gurgaon, our group level occupancy rate stands at 47% in quarter 3 of FY26 and 48% in the quarter 3 of the FY25. On to the payer mix of our hospital business. This stands at 35% for the self-pay, 35% for the insurance and TPAs, and 30% for the government business. The revenue of Shalby International, the PK Healthcare, stands at 23.9 crore as against similar number of 24.1 crore in the same quarter last year. This has just marginally declined by 1% year-on-year basis. The ARPOB on operating revenue and a loss of Shalby International Hospital is 87,526 and 3.26 respectively in the quarter 3 of FY26. In the current quarter, our operating revenue has a contribution of 51% coming from international patients in the Shalby International at Gurgaon. At a group level, talking about the international business, this stands at about 13.7 crore, majorly coming through the Shalby International Hospital with a value of approx 10 crore, and the balance 4 crore is the other multi-specialty hospitals and surgeries into the other units of Shalby Group. At Shalby, our undivided focus has been on demonstrating our clinical excellence through successful execution of many diverse clinical surgeries and several hospital units. We also take pride in sharing that we have successfully completed 32 transplants, including 29 kidney transplants and 3 liver transplants in the current quarter. Shalby also take a pride in nurturing young talent through our Shalby Academy, with 320 students registered in the current quarter into the various disciplines like physiotherapy, nursing, lab, nutrition, and clinical paramedics. This includes also hospital management, AHA workshop as part of their academic outreach and clinical exposure through internships. In the similar quarter, we had 130 new physiotherapists interns enrolled at Shalby hospitals to comply with their internship in the December 2025. Further, Shalby Academy has also successfully completed 17 batch of AHA certified with various certificate workshop at Academy in the Naroda. Now I will hand over the call to Mr. Deepak Anand to share insights on our medical implant business vertical, Shalby Medtech. Over to you, Deepak.
Thank you, Ahmed. Good afternoon, everyone. Thank you for joining us today. I am pleased to present the performance of Shalby Medtech for quarter 3 as well as the 9-month financial year 26. So we'll start with the quarter 3 financial year 26 performance overview. During this quarter 3, our consolidated Medtech revenue stood at 303.8 million, registering a 29% year-on-year growth compared to 234.9 million in the last year quarter 3. This growth was primarily driven by Shalby Medtech India. Revenue grew 77% year-on-year to 189.6 million, reflecting strong domestic execution, improved distribution reach, and enhanced surgeon engagement. Shalby Global Technologies, which covers the Southeast Asia business, revenues increased significantly to 17.2 million, up by 378% year-on-year as we continue to scale our international distribution footprint. Shalby Advanced Technologies in USA revenue remains stable at $264.6 million, reflecting resilience in the North American market despite competitive intensity. On the profitability front, consolidated EBITDA turned positive at $0.7 million compared to a loss of $69 million in Q3 financial year 25. This marks a significant turnaround by operating leverage, cost optimization, and improved product mix. At the entity level, Shalby Advanced Technologies delivered EBITDA of $16 million, up 115% year-on-year. Shalby Medtech reported positive EBITDA of $5.5 million versus a loss of $75.2 million in the Q3 financial year 25. Shalby Global Technologies also delivered an EBITDA of $1.9 million versus a loss of $1.4 million in the Q3 financial year 25. Quarter-on-quarter perspective, while consolidated revenue moderated sequentially in Q3 due to year-end and normalization in Shalby Advanced Technologies, the underlying fundamentals remain intact. Importantly, Shalby Medtech Limited delivered strong sequential growth of 18%, reinforcing the strength of India franchise. We remain focused on improving consistency in profitability while investing prudently in growth markets. Let's now move to the 9-month financial year 26 performance. For the first 9 months, consolidated revenue reached $949 million, up 47% year-on-year. Shalby Advanced Technologies revenue grew 5% to $842 million. Shalby Medtech more than doubled revenue, growing 127% year-on-year to $532 million. Shalby Global Technologies grew 35% year-on-year to $50 million. Importantly, consolidated EBITDA improved to $29.9 million compared to a loss of $98.3 million in 9 months financial year 25 with 130% improvement. This reflects structural improvements in our cost base, manufacturing efficiencies, and disciplined commercial expansion. Strategic focus areas, our growth continues to be anchored around the 5 strategic pillars: people, strengthening recruitment, retention, and continuous training of our sales team, healthcare professionals, and channel partners. We're investing in leadership development and succession planning to build a scalable organization. Portfolio and innovation, expanding our implant portfolio and improving product differentiation to drive better realization and market penetration. Customer segment focus, sharpening our segmentation strategy across geographies to enhance surgeon loyalty and channel productivity. COGS reduction, driving material optimization, vendor consolidation, and manufacturing efficiencies to improve gross margins. And the 5th one, supply chain excellence, building a more responsive and resilient supply chain to support our growing global footprint. A global expansion roadmap, our implant business now operates across key existing markets, including North America, Japan, India, and Indonesia. We have received approvals in Malaysia for our Unicondylar product and Argentina. We have submitted regulatory dossiers in South Korea, Vietnam, and Iran, and we have ongoing active discussions in Ethiopia, Paraguay, Sri Lanka, and Russia. This structured expansion roadmap positions us well to accelerated international growth over the next 12 to 14 months. Looking ahead, we expect continued momentum in the India business. The US business will focus on margin improvement and deeper customer penetration. International market meaningfully as approvals convert into commercial traction. EBITDA improvement remains a key priority through operating leverage and cost discipline. Our MedTech platform is transitioning from a turnaround phase to a structured growth phase. We believe the investments made over the last 18 months are now beginning to reflect in both revenue acceleration and margin recovery. Thank you, everyone. I'm handing it over back to any questions.
Yeah, we look forward to your questions. We can start Q&A round.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants who wish to ask questions may press star and 1 at this time. The first question is from the line of Shubham Harne from Purnartha Investment Advisors. Please go ahead.
Hello, sir. Thanks for the opportunity. I just want to ask about hospital business. What's happening there? Why our inpatient or outpatient volumes are decreasing continuously while surgical rounds are also decreasing? That was my first question.
Hi, this is Shanai. See, I think if you look at the numbers, what has happened in this quarter is the insurance work particularly has come down because we had been negotiating with some of the insurance companies. So we had to stop doing some of the work with some of these insurance companies, the 2 or 3 major insurance companies, and so for 2 to 2.5 months, we had to stop working, and then eventually the positive is that in the month of November, we have signed, in the month of November end, we have signed the contracts again. So basically, the flow in Jan and so far in this quarter has been good, and it's positive. So this was one of the reasons. The other reason was that you can see that the government business has gone up. Again, this is also because the government volume has gone up only by 8 or 10%, but the overall realization per patient in the government business is much higher because the rates have been revised. They are more favorable, more accretive. So that is kind of the other area where the revenue has kind of been compensated by some of that business. The other one is that we also lost 2 doctors in 2 of our units, 2 different units, and often what happens is there is a lot of new infrastructure that keeps coming up in some of these cities, and often they are prepared to pay any price to kind of get that business. We may not be able to match that because we believe that profitability also is equally important, and hence at times we have to take some decisions decisions at these points where we have to let 1 or 2 of these doctors leave. Apart from that, I think the quarter has been quite positive in terms of doctor recruitments, etc., because we've added 40 doctors in this quarter, whereas we've lost about 18 doctors. So overall, we've added doctors for the quarter, and that we are seeing, and we will see that play out for us. Besides that, we have already made investments in the last 120 days to 180 days in the bunkers, the linear accelerator bunkers, the radiation oncology therapy. So this is across 2 regions. So we already operate this in 3 regions right now. We operate it in Jaipur, Indore, and Ahmedabad so far. And now we've also added 2 more, one in another part of Ahmedabad and one in Surat. So that is likely to kind of play out. The one in Ahmedabad will play out throughout the quarter 4, and we are likely to receive the AERB approval very soon. For the Krishna Hospital in Ahmedabad. For the Surat Hospital, we will receive it very soon. And once, that is up and about, I think in the month of March, we should start seeing those numbers. Besides that, I would say that apart from that, the quarter has largely been flat for us. However, having said that, we see a lot of positivity in the current quarter, and we'll start seeing the numbers flowing. So I would say it's a one-off.
Okay. But in last 6 to 9 months, we have hired new doctors. So what's happening there? Is revenue coming from new doctors substantially?
Yes. So, we are putting in marketing efforts for some of these doctors. I think Dr. Nishita is with me. I think she can discuss a little bit about the marketing initiatives for such doctors. And also, besides that, the doctors where, we are not able to, we are seeing that, we are not able to derive the right results. Eventually we are also taking, the right strategic decisions on those as well. So, that's why you also see that 18 or 19 doctors have, we managed to part ways with them. But I think Dr. Nishita can throw some light on the marketing activities.
So good afternoon. See, as per hiring doctors, we are taking a mix of doctors. Few doctors we are hiring and, they are having their own practice. So we are buying out practice to be stable against the doctors left. As well as for the marketing, we are doing a lot of marketing activities, awareness programs and all. And again, supporting all these doctors with high-end technologies. See, we have placed robots at 5 of the places, orthopedic robots. We have placed other than orthopedic surgery robots at 2 or 3 of our units. And that is how to help them with technology as well as to bring in high-end, surgery revenue as well as ARPOB. And for all of this, we do constant digital marketing, awareness programs, in-house camps, free camps activities and all. So as they are
we getting positive results to this?
Yes, we are getting, but it's a slow process. Once they join here, we start slowly. It takes 1 or 2 months for them to have the old ways again.
Yeah, but I think so it's approx 9 to 6 months already passed since we have hired new doctors. So for that bunch of doctors, are we getting positive results?
Yeah, we are getting, because if you see, insurance was a big hit. Even, doctors coming in, we have to have our all empanelments online. So since quarter 2, the insurance were stopped because of rate negotiation, not giving us, revising rate for last 3 or 4 years. So now they are in place, so they will be getting that. Even self-paying patients, the new doctors have done good, but as we lost old doctors, the 2 high-end doctors, that is how there is a drop.
So, we've lost, as we mentioned earlier, the insurance business for 3 of these large insurance companies was stopped. So, overall, had that been in place, we would have definitely seen a growth. So, your question to, whether these doctors which have been hired over the last 6 to 9 months, whether they are performing, yes, some of them are performing and, but at the same time, if the hospital takes a call of not doing the insurance business, it will affect their practice. So, so as I mentioned earlier, it is a one-off where, we have seen a kind of hit in, the insurance patients. But, this, it was a one-off, as I did mention earlier.
Got it. And second, on government business, since you have told right now that the government business rates are getting revised and now it is better. So are we planning to increase that government business in near future? Or earlier we have said that we will decrease the same. So that would be our strategy.
See, there are specialities and there are different areas within the government business which are accretive, to the overall scheme of things. So we will continue to pursue those.
Okay. So wherever we are getting good amount, we will pursue that.
Yes, that's right.
And can you tell me what's happening in PK Healthcare? Because I think so insurance companies are there right now in PK. So, but now also, if you see occupancy, it's reducing quarter on quarter. So can you throw a little bit light on PK?
Yeah, for PK, there we are doing a specialty stabilization and with, bringing in other specialty doctors. So PK was usually much working on liver transplant, BMT, and say oncology work. But as 2 doctors, the BMT and liver transplant doctors have left, so we are, compensating that. We are into recruitment with liver team, but again, we are going with a mix of cardiology, ENT, orthopedics, and again, as I told you, giving them a good specialty, good high-end equipment. So we have just, hired a very senior pulmonologist. So we are going with a specialty mix instead of only working on liver and BMT, which Sanar used to do earlier.
Yeah,
and for the insurance companies, majority of insurance companies are getting closed, and we are waiting for NABH to come on board, which we are expecting by this week. So once NABH coming in, we will be also doing a lot of tie-ups for, say, Haryana government, CGHS, CCHS and all.
Also, I think what has happened is that we've lost, these key doctors, due to the earlier management, and we've kind of earlier the head of the hospital, we've asked him. I mean, we had to part ways with him because of some of the damage that was done, and hence we had lost some doctors. But yes, we are in the process of recruitment. We've recruited some of these specialities. Some of the high-end, high-performing specialties, we are under talks with a couple of these top specialists in the city. So, we will update you as and when, we recruit for the transplantation, for the liver transplant and for the bone marrow transplants. However, orthopedics is already doing really well in the Delhi hospital in Sanat, and also we have installed robots for not only orthopedics but also for some of the other specialties like Uro, GI, Neuro. So ultimately we are expecting that some of these specialties will cover up significantly for some of the lost business.
So this year occupancy rate would be subdued. I can see that means your doctors are leaving, new doctors are joining. But what is the occupancy rate which you are projecting for 27?
So look, the occupancy at this point of time, we are ranging at about 20 beds, in the Sanat hospital. In the next year, for the average, we are looking at least 40 as an average for the full year.
And then what would be the occupancy rate for hospital?
Of course, ending the year at a much higher number than that.
Okay. And then what would be the overall occupancy rate for the Shalby next year?
So overall occupancy rate, we are not giving forward-looking numbers, but the way we see it is that we definitely see a double-digit volume growth, in the next year. And then of course there is a ARPOB growth of 5 to 6%, additionally on top of that.
Got it. Thanks for the update.
Thank you. Before we take the next question, we would like to remind participants that you may press star and one to ask a question. The next question is from the line of Mr. Kashish Thakur from Elara Capital. Please go ahead.
Hey, hi. Thank you. Thank you for the opportunity. One question I want to ask pertaining to our tax rate. Our tax rate has been quite volatile since a bit long. So just wanted to understand why it is so, and what kind of average tax rate we should work in going ahead.
Yeah, this is Amit. To answer you, our tax rate has been about, at a group level, has been about 35%. The ETR rate, what you see, since currently we are investing in onto the medtech and PK side, as soon they are becoming profitable, the tax rate and the ETR rate you would see on the consistent side. One significant change, as also in the budget, the MAT changes have come. We are evaluating it out, and probably our evaluation is indicating that we would move to a lower tax rate of 25% into the Shalby Limited. That would reduce our tax expense significantly into the coming quarter. And if we do that adjustment, then the annual impact would come in the next quarter.
Perfect. So second question is more on our expansion strategy. Any light on how bed addition we should look like? It should look like in FY27.
So the thing is, we have additional capacity that where we can grow for the next 2 years or so. So at this point of time, if you notice, in this fiscal, we have significantly invested heavily on infrastructure upgradation as well as into high-end robotics and some of the high-end diagnostics. So we've installed a new PET CT scan in which will now be operational soon. We have invested in bunkers in 2 of the cities. Now we have 5 bunkers as a group. we are planning to add 2 more bunkers. So if you ask me, then the next investment over the next couple of months will be in 2 additional bunkers in Mohali and in the Delhi NCR region. So that is, planned over the next 12 to 18 month kind of range. Robots, we have installed 5 robots across our hospitals for orthopedics and 2 robots for other specialities, across, our units. Again, we'll be adding more robots for other specialities as well across the board. So, some of the investments in technology is likely to happen on a more strategic basis. With regards to bed addition, we have another 50 odd beds which can be added in the Delhi NCR region, which at the appropriate time we will take up that project. Besides that, we don't see any significant capex, and even some of the capex that I did mention is likely to come in the 12 to 24 month kind of range. So not much capex is planned over the next 12 months on the hospital business.
Understood. One question on ALOS. Our ALOS is somewhere around 4-ish days. So why it is higher? So I think so in industry standards it's been reducing somewhere around 3.5, 3.4 days. Why does for us it is around 4 days?
Yeah, the LOS is little bit on higher side due to more medical cases. So we have developed critical care unit through 3 units and had done some expansion in current beds also. So that is all due to medical cases and critical cases, the LOS is on higher side.
Should we build in a similar ALOS going ahead as well?
Yeah, it would be in the range of, it would be in this range. It will fluctuate a little bit based on the specialty mix, but yes.
Understood. And one last question. Our 0 to 5 years hospital are operating somewhere around at 6.6 EBITDA margins. So like when can we see a ramp up from these hospitals probably reaching somewhere around 10-ish% or 15-ish% EBITDA margin levels?
Yeah, so we will see this happen as the units ramp up. We are adding, we are doing 2 things, right? We are adding super specialists in some of these important specialties, and we are also investing heavily in diagnostics and robotics. So all of this put together will definitely increase the work for us, and ultimately that will translate to the EBITDA margins. So as I said, we are aiming for an average occupancy through the year of about 40 beds for FY27 for the Delhi unit. So if that happens, we will definitely be at that level, in fact even better than that.
Understood. Thank you. That's all from my side.
Thank you. The next question is from the line of Om Prakash, an individual investor. Please go ahead.
Yeah. Hi, sir. I have actually been an investor over the past 4 years. Back then, there were a lot of optionalities for the business in terms of franchisee and implant business, even acquisitions, etc. But considering a lot of things have not worked out for us, just want to understand what management is thinking at the moment and what is the plan for the future.
Yeah. So I think we'll start with the implant business. I think Deepak can, kind of lay the foundation for the implant business, and then I can move to the.
Thank you, Shalby. So from a future standpoint, I think we are in a great space after you just heard what we've done quarter on quarter as well as on 9 months time. So if you have to ask me, we are continuously working around the 5 pillars that we just met, right? So if you speak about it, every day, every week, every month, we see an improvement in our gross margins through costs getting reduced. We see our sales growing. We've already had a growth last year at about 65%, a similar kind of growth this year, and we continue to keep that momentum going. So the market is large. We're also opening up multiple countries, multiple geographies along with that. We are also launching new products. Like in the last 12 months, we've launched close to 5 or 6 products across different geographies, which has contributed to both top as well as bottom line. We continue to innovate. We continue to get top-notch talent across. And this is a large global market, so we are not here to play for a single market. It's a globally $35 billion market that we are speaking about, where we are looking at. So we are building the base. We are building our processes, systems in such a manner that we are scaling up in a systematic way for us to win the larger space. So that's what is the...
When can we see a turnaround, sir? I mean, I'm hearing this for a while. I'm just trying to understand when are we gonna break even and start generating profits from the medtech division?
So the results do have a break even right now that we've spoken already. So break even has already happened.
Got it.
I mean, if you would have just heard what I just spoke, the break even has already happened.
Got it. And sir, about the core hospital business, would like to understand what is the management plan in terms of expansion. I understand there are a lot of under construction hospitals and also franchisee business, which we have bound down in a couple of places. So if management can lay down like a broad reasons why we are winding down and why we are not able to do better compared to the market where hospitals in general are posting great numbers. Is there a specific concern with Shalby or it's something to do with, internal reasons?
Yeah, sure. So, I'll just conclude the implant segment. So the implant segment has been growing at 40 to 60% depending on the year for us. And we see it growing at that level even going forward. So, you will see the operating leverage play out significantly over the next couple of quarters. More so because the availability problem, until Q3 so far, we have had the availability problem, for the implants. I can tell you that more than 70 to 80% of the implants used in the month of Jan, from the month of Jan this year, have been our implants. So, that is a big positive for us, which until now, so far until Q3 used to be around 15 to 20%. Right? So, that leverage we will start getting now. The availability problem is sorted out. The cost of goods manufactured, at our implant business at the factory is now down to almost 50% of what we used to manufacture it at about 4.5 years ago. So a lot of positive signs there. And, as you see the volume ramp up, we'll start seeing the profitability and the cash flows play out. And it will be visible over the next couple of quarters. So you will see significant changes over the next couple of quarters. Since we are not giving any forward-looking statement, I'm not able to give you a guidance on that. In terms of the hospital business, we already are adding the right clinical talent across the board. And as I did mention earlier, Q3 was a one-off. Apart from that, if you see the earlier quarters, there has been, a growth on the other quarters. Delhi, I told you there were management issues, which, are, kind of partially resolved. And with the new clinical talent coming in, we'll start seeing the ramp up of some of these units. Investing in upgrading some of these facilities, investing in robotics, investing in diagnostics is going to play out. Over 80 crores has been invested in some of these areas over the last 8 to 9 months, which have not started, adding to the top line significantly because they have just been commissioned. So you will start seeing the impact of all of these robotics, diagnostics, and the upgradations, in the coming quarters. And besides that, as you can see in our results, the overall cost of doctors has gone up significantly. And, ultimately, it is very important to get the right clinical talent on board, and then it does take some time to play out. So, we are seeing the impact. You will see the results. We are expecting double-digit volume growth and a 5 to 6% ARPOB growth. And, you can kind of imagine the kind of growth that, we will be seeing in the quarters to come.
Got it. Sir, if I can squeeze one more question. So the question is regarding occupancy rates. So occupancy rates for us have been almost in a similar range for the last 3 years. I understand we are also expanding by opening new hospitals, especially with Nashik, etc. Would like to hear the commentary how management is thinking to improve this occupancy rates, at least on the older hospitals where we have been operating for a while now.
Yeah. So I think, one is that we should not just look at occupancy percentage, because what happens is that, over the last 3 years, we've added beds and, we look at the percentage, it's not fair. We should look at the average occupied beds, or we should look at the average inpatient count, average outpatient count, because, these are the numbers that would really matter. We know the areas where, we have not grown or, kind of degrown. But then, there are a lot of positives as well. We need to work on some of these areas, which we continuously will end up working on. But I would say overall, the outpatient, inpatient counts would be a much better way to judge where the business is going.
Sure. Thanks a lot, sir.
Thank you. Participants who wish to ask questions may press star and 1 at this time. The next question is from the line of Kashish Thakur from Elara Capital. Please go ahead.
Hey, hi. Thank you again for the opportunity. Just one question on ARPOB. How do we see our ARPOB growing in FY27?
See, ARPOB traditionally has grown 5 to 6% for us. Now, depending on, how the robotics play out, etc., over the next couple of quarters, we'll be able to kind of be in a much better position to, kind of tell you in a couple of quarters, because that 5 to 6% is something that we definitely see it growing because of the SOC rate revisions. Even some of the government insurance companies like CGHS, etc., have increased their rates. So all of that, we have already seen, and some of that is already playing out. But apart from that, robotics will add significantly to some of these ARPOBs.
So just following back on the same, like you just mentioned on robotics. So just wanted to highlight, we have already done around 32 transplant patients during this Q3. So like, how are the margins different for the robotic patients slash transplant vis-a-vis the normal surgeries?
Transplant, knee transplant?
Organ transplant. Liver and kidney.
How is the margin different? Should I repeat or clarify my question?
Yeah, please repeat, Kashish.
Sure. So I just wanted to know the difference, like when a traditional surgery is performed vis-a-vis when a robotic surgery is performed, which is more profitable for us. And we have already done somewhere around 32 transplants in Q3 is what is mentioned in our presentation. So like what is our aspiration for the same in FY27?
So I will just answer your question, but before that, I want to tell you the key specialities for us. The 5 key specialities which we continue to kind of lay a lot of emphasis on is orthopedics, where we are globally the number 1 player. The second one is, oncology, which is growing for us significantly well. The third is cardiology, because the volume of business in the cardiac segment is large. Apart from that, the fourth one is intensive care and emergencies, because again, ICU beds, are high ARPOB generating, and ultimately it does kind of drain a lot of patients from the 10 to 15 kilometer radius. The fifth one is neurology, and the sixth one is, of course, the transplant. So the transplants, the volumes are always lower, compared to some of these other specialties. But ultimately, you are seen as a center for higher tertiary quaternary kind of care, right? To answer some of your questions, I think the transplants are generally not done by robotics. Okay, and so that is one. And the typical length of stay is longer for these transplant patients. So they usually end up staying for between 15 to 20 days.
Understood. And if
have I answered your question or?
yeah, no, that's fine. If by chance I had skipped, have you mentioned any timeline on EBITDA positive or EBITDA break-even for our Shalby International Hospital?
Yeah, see, if you ask me, we were likely to be EBITDA positive over there about 2 quarters ago. So, there has been a delay on that front. As we mentioned, because of some management issues, there are 2 things happening which give us a lot of confidence. One is the new clinical talent that we are onboarding. But second and more importantly, the NABH is expected to come in very, very soon. So once that comes in, you will see a step kind of an increase in the work that we'll be doing. So we are very positive, for the next 1 or 2 quarters that we will be able to see the numbers change very drastically.
Understood. Thank you.
Thank you. The next question is from the line of Viresh Sangwan, an individual investor. Please go ahead.
Hi. I got most of the questions answered. I just want to know about the Mumbai hospital, in the expansion and everywhere. You did not mention about that. So what's happening on that front?
So on to that, our partner, the trust, is reviewing certain terms in the agreement, and there is a close discussion happening with them. Once the terms are reviewed by them, then only we'll be able to update you out that any development on that front.
Okay. And lastly, where do we see our debt trajectory in maybe next couple of years? Where is that going?
Sorry, can you repeat the question?
Our debt, net debt, where is that going? What's the trajectory for that in next couple of years? Thank you.
Yeah. So as I did mention earlier, that we are not expecting any significant capex in the hospital business, or for that matter in the implant business, for the next 12 months. Besides that, our ramp up because of the consumption. So I did mention earlier that the consumption of the implants in our own hospitals, as well as the sales of these implants in some of the geographies like India, has ramped up significantly and is likely to ramp up significantly. So with the higher profitability, higher sales revenue coming in from the US, for the implant business, the funding requirement there will be much smaller, over the next few quarters. So, and the hospital business will definitely generate a significant EBITDA. So I think the way we see it is that the net debt 12 months from now should be a little lower than where we are at the moment. So the way we see it is that the funding requirement of the implant business will be, say, 30 to 40% of the EBITDA that we generate. So we are hoping for a turnaround there, and the debt should go down.
Yes, thank you.
Thank you. The next question is from the line of Om Prakash, an individual investor. Please go ahead.
Yeah, thanks a lot for the opportunity again, sir. So first question is, considering the experience with the recent acquisition in Gurgaon, just want to understand how management is looking at growth in terms of hospital business, especially on franchisee acquisition versus organic. If management can just lay out how their thought process is, it will be really helpful.
Yeah. So look, I think for the hospitals, as I did mention, the growth plan is really that we can practically, from the current levels, do 60 to 70% more work in the existing hospitals with the kind of new investments that have come into robotics as well as the infrastructure upgrade and some of the diagnostics. So with all of this and the bed capacity, we should be able to do between 60 to 70% more work than what we are currently doing. That is, one ramp up that we see. The mobile facility is something that will definitely come into play. The other thing is that there are also some opportunities where we can add capacity, like I mentioned earlier in Delhi, etc. We are able to add, because of the additional FSI that we have, we are able to add beds and kind of increase the capacity as well. There are a couple of inorganic opportunities that come by, small and big. We continue to assess them, but there's nothing concrete that we have, in our plans as of now.
Okay. In terms of franchisee, I'm assuming you're not looking at it aggressively. Is that right?
Yeah. For the franchisee, we are not looking at it, and in fact, we have closed down the Rajkot as well as the Lucknow facilities. And, we have started doing OPDs from there. And, we did realize that, a lot of patients did end up traveling and, prefer to travel to some of our larger units for treatment. So it was a strategic decision taken. And we are not planning to add significant franchisees. The good thing is that the capital investment and the capital outlay in some of these franchisees was very minimal. So, overall we see that, it's a positive for us. And the flow of patients coming in from these cities has, remained the same. So as such, the impact is only, there's no negative impact. The impact is only positive.
Is it fair to assume then that we might not be investing heavily on the franchisee route anymore in future?
Sorry, can you repeat that question?
Yeah, I meant to ask if recent experiences about wind down, etc., can we safely assume that franchisee might not be able to double down? It's more to do with just running on the back burner. Is that a fair statement?
Yeah, so I'm not sure if I heard you correctly, but if you're asking me about the franchisees, yes, we are not looking to add franchisees, as of now.
Got it. So my second question is actually on the doctor mix, the new hires that we are doing. Right now we are heavily reliant on arthroplasty. Are we looking at increasing a better mix with new hires, or in future also to continue to be more focused on arthroplasty as a primary revenue driver?
Yeah, so if you look at the data for this quarter, about 33% of the work is arthroplasty. Okay, so exactly if you ask me 10 years ago, we were at about 70% arthroplasty. And 15 years ago, we were at 95% arthroplasty. So we have consciously worked on, one obviously to increase the arthroplasty business because the volume growth in India is significant. But at the same, and we are globally the largest player. But at the same time, we have focused on some of these other specialty areas where each of these specialties like oncology, cardiology, intensive care, these are all between 10 to 15% of our revenue today, and they are growing higher double digits. So we do believe that there is a lot of potential in some of these other specialties, and hence we have reached this level. Now, whether arthroplasty will come to 10 to 15%, very honestly, is a tough question because we do the highest volumes. So, we do believe that we will always be between the 20 to 30% range for arthroplasty, going forward. We would want to be there. It's a high ARPOB generating business with high profitability. So, it does make sense for us while we continue to build on some of these other specialties.
Yeah, but if you look at new hires, are we doing more on the arthroplasty or it's like a distributed model?
No, it's absolutely distributed. It's distributed and, as I did mention earlier, arthroplasty, oncology, cardiology, neurology, transplants, and intensive care. These specialties are key specialties for us. Essentially, we continue to invest in clinical talent, in the infrastructure, technology across these, and also, of course, some of these other specialties, but the higher volumes are these 6 specialties.
Got it. I had to ask because generally the high margin categories are oncology, nephrology, and cardiology. Just wanted to know if management has any inclination towards growing these aspects in the overall pie. That's where the question was.
Yeah. So, out of all, we also do a lot of work like transplants. We also do, dental work everywhere. We also do work across nephrology, etc. So, we have 30 to 40 specialties. I mentioned the 6 specialties which are of key focus to us.
Got it, sir. And sir, if I can squeeze in one more, it's regarding this implants business. I understand we are actually growing healthily and the break-even is also very near. I mean, we've already reached. But can we get like a split of how much is actually consumed by Shalby versus sold to external clients? Is that possible?
So I can give you like a ballpark idea. So till about quarter 3 of this year, I would say Shalby's consumption would have been in the range of 20 to 25% in total. But that scenario, like what Shanai said a little bit earlier, changed in January because of the supply issues getting resolved. So from this quarter onwards, you will start seeing large consumption happening at Shalby.
And if I may ask, where is the consumption majorly happening? Is it in North America? I understand we are in 4 geographies now. But where is the high demand? And is the margin, I'm assuming it's better in the USA compared to other geographies. Is that right?
Absolutely.
Yeah. So is it okay if you can share like a rough split of the geos where we sell how much and all?
So we're currently doing about, if I have to take out a Concall level, we'll be about 60-40 by the end of the year. 60% of the business would be OUS. When I mean OUS, it includes India, Indonesia, Japan as of now, and it could be multiple countries in time to come. And the rest 40% is US.
Okay. Thanks a lot, sir. That's it from my side.
Thank you.
Thank you. The next question is from the line of Saket from Sagarika Capital. Please go ahead.
Hi, thanks for the opportunity. So, sir, a couple of years ago, we had outlined 100 million aspiration for the implant business. So, can you kindly update, has there been any change on that aspiration or what's the typical timeline now we are looking at vis-a-vis this $100 million aspiration for implant?
So I'll give you a little bit idea, but we're not speaking any future, guidance or anything here. But the aspiration obviously remains the same, and it doesn't end at 100 million. Actually, it's beyond that as we look at it. So the reasons, if you look at it, why we could not reach to where we had to reach were fundamentally around 2 reasons. One was around the regulatory policies, and the second was around capacity, right? So these were 2 large reasons for us which held us from getting to where we had to get to. Out of that, we've solved the capacity issues to a very large extent. So that is a good solution that has happened. On a regulatory front, it will continue to be uncontrollable thing because it is driven by multiple things, including geopolitics and things. But we know where to put our bets, which country, what has been there, where do we have to enter. So that mapping is done. So we are quite clear about where we want to go from that standpoint and what are the regulatory challenges and roadblocks and solutions that we need to be in. And from a capacity standpoint, I think it's 80-85% resolved. So these are the 2 large reasons because of which we couldn't get to the aspiration that we had planned for. Now, with both hurdles almost coming to an end, I think we should be on a good track.
So, what's the aspiration? So, right, I think, are we PAT break-even right now or only EBITDA break-even as far as implant business goes?
We are not PAT break-even right now, but our PAT is significantly gone up, like from negative almost 50% to about negative 25% at a PAT level. But this is primarily happening because of two large reasons, right? One is CapEx from a standpoint of instruments and other things. We need CapEx. Without CapEx, it is difficult for us to do business. So that is done. But to a large extent, that CapEx is already incurred. We will not continue to have the similar kind of CapEx for the next 2 to 3 years because that CapEx is incurred. The second is new product development, right? I mean, that is still something that we will continue to put behind R&D and research and other things, which is important from a company's future and growth standpoint. We cannot halt that. So outside that, I think we are in a good position. But even at a PAT level, we've broken even at EBITDA, but even at a PAT level, if I'm right, it's increased by a good amount.
So when is the, say, likelihood of PAT break-even? Is it like FY27 or 28 we are looking at as far as PAT break-even is concerned?
So we will provide you that as a guidance at this juncture. We're not doing any guidance at this juncture.
Okay, fair. So another problem that, again, I've looked at this industry as a consultant as well. So one challenge has always been one supply chain, and another is inventory planning, because for particular implant you need different sizes, right? Depending on that girth. Now, how confident are we on these fronts as well, right? That our supply chain is now in top shape, and also because our given, despite our size, we are already present in multiple geographies. So then that further complicates things, because again, multiple geography means multiple height and weight of people, because a Russian or an American would be very different from what an Indian would be. So are we on top of things as far as that supply chain aspect is concerned, including inventory planning now?
No, cannot agree more. Cannot agree more with you. Planning is the number one thing over here, because whether it is to do with lead times, regulatory, everything is completely dependent on your planning. So we have some really solid top-notch talent in the company who could do planning. That's one of the reasons why we have been able to fix this at a short duration. So if you look at it, the capacity challenges that we've been able to identify and fix it in the last few quarters has been significant. So that is one thing. Second thing is, the inventory is a function of two things. Inventory is a function of planning, and inventory will also be a function of new products. So there will be some kind of inventory, but we will be able to cognizantly balance between what we need to liquidate, at the same time what we need to build from a new product launch standpoint. So that is the first thing on the that you spoke about, supply chain, and the second one is about inventory.
Okay. Now coming back to the standalone business. So while again one of the challenges that Shalby has faced is on the profitability front. Even if you look at, say, today maturity wise, and thanks first of all for sharing this data, that granularity that you have shared this time. So 10 plus years we are in the 20s, but even hospitals that are, say, 5 to 10 years old now are still hovering around 14 to 15% kind of EBITDA. And that's why, unlike other hospitals where I think Shalby has been slightly left behind, is our operating leverage hasn't really kicked in. We have become a chain now. Our top line growth and bottom line growth are almost kind of identical. So the 5-year trend that we have talked about, so it's 12% CAGR for top line, and bottom line also 13%. So what really is the challenge right now? Why even our 5 to 10 years hospitals are still hovering around 15%? Have you been able to diagnose the problem, or you think that that's the normal rate, because again you are more ortho or say that kind of focus? So is there something that we can expect, say a proper or say a solid improvement on the EBITDA front, especially for the standalone business?
See, I would say, we should not look at it, from that perspective that, because it is in the 5 to 10 year bucket. But, I'll tell you, I think it's a fair point what you're mentioning. It's a good question. So what happens is every unit has a specific reason. So, for example, the Jaipur unit, as we speak, has done well in this quarter, despite, us having lost one of the key doctors there, right? At the same time, what happens is, maybe a unit like Naroda, which is again in the 6 to 10 year bucket, now, for example, we do a lot of government work there. So, if we want to take up cardiology, the government changed the rules suddenly where, we need to have a full-time cardiac surgeon. So, we had to start recruiting one because earlier we used to have visiting cardiac surgeons to do these procedures. So, there are often, changes that happen. Like, for example, I did mention about the insurance, tie-ups, where we kind of stopped doing work with some of the insurance companies temporarily. So, there are multiple things like this that happen where, again, when you hire a doctor, again, it takes a couple of months. So, it is part and parcel of being in this space. But no, these are not the normalized margins. The normalized margins are in the range of 20%. And, we are positive that we are inching towards getting there for some of these units.
So, sir, would there be there is some sort of, for this inflection point of, say, stable, say 18 to 20% group level margin to kick in? Is there, say, a critical mass that we are looking at? Because right now we are, say, more in the 2300 to 2400 kind of bed size. And on top of that, there is some geographical concentration as well. So, which leads to, say, one or two state regulatory changes or, say, one or two major facilities it ends up impacting our group as well. So the benefit of having a corporate setup where these things can kind of say cancel out, and that diversification is yet to kick in our case. So is it like, so maybe once we are at 3,000 or say 3,500 kind of bed setup, then we should expect this 18 to 20% start that the margin becomes much more stable or say less volatile or exposed to volatility as far as some of the developments that you just highlighted. So should we? So is that a realistic expectation, or do you think we are well placed already? That critical mass is already there. It was just that we were on the wrong end of the stick for a couple of quarters.
Yeah, so you're right. As you add units, as you add beds, then you have some of the units where if one or two units have operational issues, the others cover up. But we are already in a sweet space because we already run more than 10 units, more than 2,300 beds. So we are already in a good space, and I can definitely tell you that with ramp up, and the kind of bed capacity that we have, the kind of growth that we'll see in terms of occupancies as well as in terms of the inpatient outpatient counts, we can definitely not only stabilize at a 20% margin, 20% I said for a typical unit, but at a group level, we definitely, as we see the ramp up, we definitely can go up to 23 to 25% also at a 50% higher occupancy than what it is right now. So we will have to kind of wait, as I said, for a couple of quarters. We see it happening. We see the numbers. We are, as I said, we have invested heavily in technology. So, it will be visible in the quarters to come.
Okay, thank you, sir. Really appreciate your responses and best of luck for the future endeavors.
Thank you.
Thank you. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Thank you everybody for joining the call. We will connect again into the next quarter. Apart from that, if you have any questions, you can reach out to our investor email ID. Thank you.
Thank you. On behalf of Elara Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.